Option trading. Today we'll talk about option and volatility. So this is a volatility or a standard deviation curve, as you can see. Currently stock is at $50 and volatility is very low at this point. So when the volatility is low, the standard distribution curve is somewhere centered toward the middle. As you can see here, the price really does not move too much. It's from 50, it goes all the way to 44 on this side and 56 on here. So the basic thumb rule is really when the standard deviation is when the volatility is low, the price moves not too much. It will kind of move around one standard deviation for most part. So this is when the volatility is low, you got to make sure you are a net buyer of the options. Obviously you have to understand the market direction. So next scenario we have is really medium volatility. This is the the yellow or the orange line here. When the volatility is medium, the spread of prices, as you can see here, it goes further along. So before it was 44 when it is low volatility. Now it's a medium volatility. It goes all the way to 42 on one side and 59 on the other side. So the price points are more distributed, as you can see here. And when the volatility is low, which is the red line here, the price is even more distributed. There are multiple price points, as you can see, both sides. So our edge as option trader is to really understand this volatilities very well. And in most of the trading platforms, including Thinkorswim, there is something called an IV rank. When the IV rank is very low, this is when you have to look at option buying strategies. And when the IV rank is very high, that's when, if you see here, there's a red bell curve here. This is when the volatility is very high. This is when option prices will be more at this point. You can be a net seller of options and basically sell some options at this point. So the key thumb rule from this is really volatility varies depending on time to time. As an example, just after the earnings, volatility will go down. We call it volatility crush. That's when stock may be up or down, but volatility will be low. That's a good time to really look at some of these option buying strategies. And just before the earnings, as an example, or any big event, the volatility will shoot up. This is when option prices also will shoot up, and this is a good time to really sell some of the options. So that's the key takeaway from this slide here. We'll move to next slide to look at what are the option strategies to take advantage of this volatility. So as you can see here, the way to read this chart is we have volatility here in the column. There's the low, high, and not applicable. And then you got market direction or a market sentiment, or what you think about the market. It can be bullish, can be bearish, could be neutral. So if volatility is low and you have a bullish outlook on the market, this is when you can buy call options below the strike price, or you can sell put options below the stock price, or even you can do a bull put spread, and in the previous on here you can even do a call spread. And you can also do call ratio spread. This is where you short a call at a higher price and you long two calls or a higher amount of calls at a little bit lower price. And you could also do put ratio spread. This is where you short two puts and long a put. And when volatility is low and your outlook is bearish, this is where you can do a long put position or you can buy put position. So because volatility is low, you can buy it at a lower price, especially when the stock is super hot and it's too high at higher point and the volatility is low and you're expecting stock to cool off a little bit. This could be a good time to really initiate a long put position. Then there are neutral positions. Volatility is low and your market assumption is really neutral. So in those scenarios, you can go with the multi-prong approaches. You can look at straddles, strangles, iron fly, condors, and some of these neutral market type strategies to take advantage of neutral or a choppiness. And because volatility is low, you are net buyer here. So you are basically opening a debit position, and you're really making sure volatility will increase as you go along. The second one is really volatility is very high, as you can see here. So when the volatility is high, you can really take advantage of it, and you can sell some options. Good examples could be, you could sell some straddle, which is really at the money call and at the money put. You could really sell a strangle or a short strangle, assuming you're hoping at this point volatility will cool off and stock price will really will not go too much here or there, kind of sort of neutral to some, or it can move a little bit, not too much. Or you can do a long iron condor or a condor type play here, and short butterfly. One thing to notice about some of these short strategies, you don't want stock to move too much. It should be in a given range. So it's the range bound type strategy. Then if your outlook is bearish, this is when you can do a short call option. Suppose stock volatility is very high, and stock is also at a high price point at this point. You could basically sell a call option at a higher price than the current stock price. You could also look at things like delta and make sure you basically look at delta 15 or something along those lines, which is much higher than current stock price. And you could look at call ratio spread. You can long or buy a call and short two calls, or you can also do a put ratio spread. You can do two long put and one short put. And if you're a neutral, this is where all our butterflies and some of these condors will come into play. Your volatility is high, you are neutral, and most of the strategies, as you can see here, you are short. Basically, you're short or you're selling. So when the volatility is high, you basically look at selling, option premium for most part. And then the last one is really neutral. So volatility, is, you really don't worry too much about volatility. This is when you basically do a bull spread, meaning you long a call at a little bit lower strike price than the current stock price, and you short a call at the higher price. You could do calendar call, diagonal call, or you can these are the few strategies here. If you're bearish, you can do bear put spread, calendar put, diagonal put, covered put. So this is a summary of option strategies. Again, I will stress here, you have to understand volatility to really get an edge on the option trading. Unlike stock traders, where mainly they look at the direction and initiate the positions, as an option trader, we got to look at both direction, bullish, bearish, and neutral. More importantly, we have to understand the volatility. Our edge is really to understand volatility very well, and combine that with our market sentiment, and go from there. And volatility is very obvious, because in any trading platforms like Thinkorswim or any platforms, you look at IV ratio, which tells you whether it's high, low, or somewhere in between. To understand the bullishness, bearishness, and neutral, this is where you can understand or look at some of these technical indicators, like on the balance volume or RSI, or some of these oscillators. And also you can look at the fundamental. For example, if the company is gaining a market share in a given direction, clearly it's bullish, it's gaining over the competitors. Whereas if a company is really not doing very well, it's losing the market share, that's when you can become bearish. So in a nutshell, what did we learn today? We basically learned, as an option trader, our edge is to understand volatility, when the volatility is low, we are net buyer of the options. When the volatility is high, we are net seller of the options. But when the volatility is kind of, you know, you can also do some of these neutral strategies when you don't really care too much about volatility, and look at some of these, spreads and some of those strategies. So that way, you really don't care too much about volatility, but at the same time, you want to, trade along with the market. All right. Thank you very much. Happy trading.